All right, if you're getting into selling vertical credit spreads, let's say out of the money on the put side or even on the call side, you might be wondering, okay, well, what way can I go in and pick these stocks? How do I choose these vehicles to go in and sell these vertical credit spreads? Well, in this video, I'm going to share with you two different ways and methods. And if you don't know me, I'm Sasha, the options coach. I've been teaching people to trade options over the last decade. Now, in here, we take this concept from one of my latest classes here. This is Selling Vertical Spreads, where we did a 3-day workshop. If you're interested with more information about this class, just let me know, shoot me a message, go to our website, and I'll give you some more details, book a call. And you can see a ton of other classes that we've done here recently in the past. Anyways, the point is that people are interested in trying to figure out, okay, how do I choose these vertical spreads? Do I go in and scan for them? Do I go in and pick a vehicle and go to the scan and try to find a certain way of a scanner? Or do I go in and go to a hot list or something to that effect? So I'm going to share with you two methods here, and I think it's not too crazy and not too difficult. So one of the methods is that when we think about price is going to shift and move in all sorts of ways. Now, you could go in, the first method is going to be sell into strength. And what that means is that when we look at price movement, as it gets stretched out, it's like a rubber band effect. And once it stretches to the downside, it's more likely to have this upward movement or retracement. So what we can do is if the stock is moving down or lower, you can sell into strength at some point, meaning, hey, go against it because you're looking for this whip up on the other direction. So when you're in these different spots, this is where you would sell a put vertical credit spread. Because now you'd be able to get further down the line, like somewhere over here, way farther away from that position, rather than if you were selling it kind of up here, well, you might only be able to get this much range. You're not getting a lot of range. But if you're able to go further, you get a whole lot more range after that down move has happened. So that could be much more beneficial. The other thing that you could do is that not only selling into strength, sometimes you see a trend. So the second method here is going into with the trend. So if you start seeing things trending, like let's say we've got another position here where, okay, we're kind of moving in this way, and this is how it's going. But the thing with this is that we've got an overall trend kind of moving in this direction. So what you can kind of do is go in and start selling maybe as it's trending higher on that pop, you're selling under it, okay? It's kind of going down, it kind of comes in, it bounces off of here. You're like, okay, I'll sell some more. So what you're doing is you're going with the trend. Now, this could also be with a moving average. So let's say it breaks a certain moving average and price is going, then you're going with the trend again. And that's another way of kind of looking at it. So I'll show you these methods on kind of this chart or diagram, and let's check it out. Okay, so let's take a look at pull up a stock. Let's go with PayPal. Okay, this is a nice clean view, actually, if you take a peek at it. What we've got here is a simple moving average. Actually, this is an exponential moving average. It's a 33-day. Now, you could use 21. That is, 20 trading days in a month. You could use 21. 33 eliminates some of that that little bit of the whip, so you can see it kind of breaks it a little bit here and a little bit there as it's starting to kind of break down. But my point here is that as it's trending, we could go in with a trend. So we're selling vertical put credit spreads right here. And then as it comes into the trend and goes against, sell some more. And as it goes down and under, ooh, right here, wait. And now again, you start selling some more. Okay, so again, this is a little bit choppy. So now you got into some problems, and now we're trending down. So now you could be looking at call credit spread. So it gets up there into the trend, sell higher up, and then it goes down, pops again, the trend is down, so we push it that way. So that's a simple way to use a simple moving average to go ahead and do it. Now, the other way to do it is even if you didn't have a moving average, let's take the same principle and approach, but let's say we remove this moving average for a minute. One of the ways to think about it is to go in and on big down days or a couple of down days, even if you don't have indicators or something like that, as simple as this is after a big down move, you'll be able to sell at lower levels looking for a little snap up. Okay. And on a big up move, when you're up here, you'd be able to sell at the higher end looking for a little bit of a down move. So that's how you could play it. So even if the trend is up, as long as you do it kind of on a big up move or going against the grain, then you sell up at the higher end, you get a pullback, you get out of it. So that's another way of doing it. So you've got either going into the trend and working the trend, or you could go in with the against the grain into strength because of the rubber band effect. So remember, when we look at price can do kind of two main things. And I'll show you what I'm talking about here. Is that if we look at the average, and I'm going to switch this study to do more of a 21-day, just because it's a little bit easier to teach this concept or principle, is that when you go into price is going to do one of two things. Okay, for a lot of people, they're looking for it to break away from the average. Okay, price really, technically in a way, price is not really real. It's moving around and very dynamic and organic when it comes to trading. So if we really look at what's going on with price, what can happen is that most people are looking for price to break out of the mean. They're looking for it to break away. Okay, so you see what's happening here is here's our average, and then right here at this spot, we're looking for it to break away. Okay, so we get here, we're looking for it to break away. That's what most people do and most people think of. But there is another concept behind this, is that in a lot of cases, you also want to look at price breaking in to the average, okay, breaking towards the average. So you can see when we get too far stretched, we break back to the average. Now, sometimes that trend could go for a little while, and but in general, we come back. Even when we're trending here in this upper end, what happens is that we come back to the average, quite a few times or close to it. We're coming back into that average spot. So even though we are trending up, we're coming back to that average, but that average is continuing to move up. So you've got kind of two of these methods, but one of the methods is to break away and the other is to break back into. Now, if you do this on the downside, meaning the opposite side of this, well, over here, when the stock is under that moving average, we're looking for it to break into the average. Or when we're at the average here, we're looking for it to break out, right? So we're at the average, it could break out this way or this way. So what did it do? It broke out this way. When we're at the average over here, break down or break up, it broke down, okay? Or in here, well, we broke down. So that's the thing, is that it doesn't matter which chart you pull up, you're gonna have those things happen all day long. So look at this right here. We come back to the average, we broke out, but look, we got so far stretched, we broke back into the average. And then when we broke too far out, we broke back into the average. Okay, so here we broke out a little bit, and then over here, we broke out of the average. Okay, so that's really what's happening with price all the time. And when you're selling out of the money vertical credit spreads, you can go in and do it on one of those two methods. Is if you're going with the trend, you could just, hey, follow the trend and keep selling vertical spreads. Or the other way is kind of look at when you're too far stretched or extended on one side or the other, and then sell a vertical spread around that area. Okay, so that's kind of my 2 points regarding this. Hope that helps. If you've got questions about some of our classes, let me know. There's a ton of classes that we do, and keep me posted. Let me know. And if you want some free PDFs, send me a quick message and email. Thanks for joining me, and I will see you on the next one.